retracement levels. This is what traders often call the golden zone. This area tends to act as a strong resistance zone, where price often stalls and resumes the downward trend. If you're going for a more aggressive entry, you could place a sell limit order inside the golden zone, aiming to catch the next wave down before confirmation. Just keep in mind, this strategy offers higher reward, but it also comes with increased risk, since there's no guarantee the retracement will stop there. Now, while entering trades within the 50% to 61.8% Fibonacci zone can be effective, I don't recommend using this strategy in isolation, and here's why. Let's walk through this example. The market is in an uptrend with a strong bullish impulse followed by a pullback. We apply the Fibonacci retracement from the low of the move to its high and set our entry inside the golden zone, between the 50% and 61.8% levels. But here's the catch. Instead of bouncing and continuing upward, the market breaks straight through the zone, keeps falling, and eventually hits our stop loss. The result? A losing trade. This is exactly why relying on Fibonacci levels alone, without additional confirmation like MACD, structure shifts, or candlestick patterns, can lead to false entries. So how do you increase the odds that the 50% or 61.8% Fibonacci retracement will actually hold? That's where a technique I personally use comes in. I call it the TLL method. It's simple, effective, and when applied correctly, it can dramatically improve your entry accuracy in trending markets. Let's break down what TLL stands for: trend, level, and liquidity sweep signal. For a Fibonacci retracement level to hold, you ideally want all three elements to line up. Let me walk you through a chart to show you how it works in real time. Here, the market is in a clear uptrend, strong impulsive moves upward followed by retracements. Now we spot another pullback, so we draw our Fibonacci retracement from the start of the impulse to the high. Look closely, the 50% retracement level lines up perfectly with a previous resistance that has now turned into support. This is key. In traditional technical analysis, old resistance turning into new support is a classic signal. When price revisits this area, it often bounces. So at this point, we already have two solid factors. The trend is bullish, buyers are in control. We've identified a key level of interest. Previous resistance turns support right in the golden zone. Now we look for the final piece, the liquidity sweep signal. And here it is, a pin bar candle that briefly dips below the support level, grabs stop losses, and then closes back above. That's our liquidity sweep, a classic move by smart money to trap retail traders before the real move begins. With all three TLL components in place, this trade setup now has high conviction. Here's how we'd execute it. Entry, at the close of the pin bar. Stop loss, just below the low of the sweep. Target, the next resistance level. And look what happens next. The market respects the level and rallies straight to our target. This kind of setup, backed